And now I'm with you, Kavita, and with me is my colleague Nupur. And next 1 hour is going to be all about your stock-specific question. But because we are in the thick of all the quarter results coming up, we are also connecting with managements, and we should not forget the debut listings that have happened today. So let's shift focus and let's talk about Indomim. Strong debut for Indomim on the markets today. 46% premium. It's a global leader in metal injections molding. And let's talk more and let's talk about their growth and all the infusion that's going to help the company extend further. We are joined by Mr. P. Balasubramanian. He's the VP Finance and CFO Indomim. Hi, good morning and welcome to the show. Congratulations on your successful listing today. Just want to understand if you can just walk us through the company's long-term growth roadmap going ahead from here.
Madam, actually we are in three major technologies. We are into injection molding, investment casting and 3D printing. We cater to 5 different industries: automotive industries, we cater to medical industry, defense industry and aerospace industry and consumer industry. We are seeing great growth as a company, and as an industry we are seeing great growth in defense and medical. We expect these industries to outperform other industries that we are in. Consumer industry is new to India. Thanks to the PLI scheme of Government of India, there are more and more industries coming into this segment, and that also throws up interesting opportunities for us as a company. So we feel on the whole, the 3 of the major segments in which we are operating are seeing good growth, and Indomim also will stand to gain on account of that.
All right. Right. Now, how do you view the sustainability of the company's growth trajectory? Now, do you see any execution challenges going forward?
We don't see that, madam, because the kind of growth projections that we are mentally thinking is such that we will be able to handle it comfortably. We have good capacity utilization number. In our main capacity utilization is about 45 to 50% right now, and it's growing up. We have sufficient capacity inside the company, and we have the capability. We are the largest manufacturer of metal injection molded components in the world. So there is nothing that we cannot do in MIM technology that anybody else can do better than us. So we don't see any challenges as far as our main line of business is concerned. As far as investment casting and aerospace machining is concerned, we have established ourselves as a good player in this industry, and our skill sets are such that today world leaders in this technology, world leaders of world-leading customers do come to us on their own, seeking more and more products. So we don't see any execution challenges as such on any of our lines of business.
No, but Mr. Balasubramanian, what is your outlook on demand across key markets over the medium term?
I lost you. I can't hear you.
So I'll just repeat the question for you. I wanted to know your outlook on demand across key markets over the medium term.
We do see that aerospace industry is growing by an average of about 40%. All the industries are experiencing this, and I know Indomim is no different. Gas turbine business, because of the new, the data center applications, there's a great demand for energy. So gas turbine business is growing stupendously. It is expected to grow by an average of about 50% for the entire industry. And we are also a party to this industry, so we don't see any challenges on those 2 counts. As far as MIM is concerned, we have a robust library of about 6,400 components which we are executing month on month, and we are adding at an average of about 35 to 40 new components, which is also mentioned in our prospectus. So our growth trajectory continues to be strong, and we feel that the growth will continue in days to come too.
All right, Mr. Balasubramanian, thank you so much for joining in and talking to us today. So that was the listing of the day. Indomim listed almost at a 46% premium. But let's move on and let's check the market breadth. We definitely opened strong, but right now we have fizzled out slightly. Talking about the broader indices, mid-cap and small-cap 100 trading with almost 0.5% cuts. But then there's a mixed bag in terms of sectors. IT definitely leading the pack with almost 2% of gains. But if we look at reality, that's a big lag today, almost 2% cuts on the sector side. PSU Bank almost 0.5% cut on the index, but look at Nifty Auto, even that's a sector that's doing well. We are joined by Kunal Bothra in the studio. Let's take a quick market commentary from him. Kunal, hi, good morning. Welcome to the show. Okay, so we opened strong, but now it looks like a mixed bag in terms of sector performance also, and there's a lot of individual performance because of the quarterly results that's been coming up.
It's a good day for the market, I'll say, Kavita, because, given the kind of handover we were expecting, almost a 75 to 80 point downtick on the index, it's good to see that the Nifty is actually flat to slightly positive. Bank Nifty is underperforming, which I don't see as a major change of view, because over the last, I think, in fact, this entire month, the July series so far, the Bank Nifty has been one of the key underperformers sector specific wise, and within the banking names you have a slew of private and the PSU banking stocks which have grossly underperformed. So I believe that the market texture is quite okay. You're seeing the advanced decline to be a little bit more on the flattest side, but when we look at this over the last 3 days, we were last week Friday we were almost on the verge of breaking 23,500 600 levels. From there, for the markets to recover and come back to about 24,300 mark itself indicates that after this 500 600 point recovery, we are going through a patch of consolidation. So bias is extremely bullish on the indices. It's just that we've hit that patch of consolidation after a series of good last couple of days for the indices.
All right, Kunal, thanks very much for that quick perspective on how the markets are performing. Well, we slip into a very short break right now. On the other side, we bring you more. Stay with us.
Hi, welcome back. You're watching Buy Now, Sell Now, and let's shift focus to Viga that has posted very strong set of numbers. Early in the trade, were almost up 10%. Right now, we can see almost 8.5% up move in the stock. We have seen that the first quarter earnings and profit and operating performance has improved sharply. Consolidated net profit has come to almost 130 crores for the June quarter, up 75.7% from 74 crores in the corresponding period last year. If we talk about revenue from operations, that has gone up to 23.5% year on year to 1,811 crores compared to 1,460 crores a year ago, reflecting healthy business growth during that particular quarter. But then let us just dip into the management that has joined us and ask them about the further trajectory. We are joined by Mr. Ramachandran Venkatraman. He's the director and CEO of V-Guard. Hi, good morning and welcome to the show. Q1 revenue growth of almost 24% year on year. All business segments have also delivered double-digit revenue growth. Just want to know what has aided this kind of a growth and what is the top-line outlook for FY27?
No, I think as far as the current financial year is concerned, I think we had a strong summer as far as South is concerned. So the southern region has done well, and which has actually driven the overall growth. Also, this quarter, there has been significant pricing inflation in commodities, right? Significant part of which has been transmitted through the quarter, right? The combination of these two have driven our growth, although our underlying volume growth still remains in double digit, powered by a strong summer in South. We expect to do well this year, considering that last year has been challenging, and we've had a reasonably decent start as far as summer is concerned in South. Yeah.
Right, so you have given a guidance for around 15% growth. Now, given the stronger than expected start to FY27, do you see any upside to this guidance, or would you prefer to remain conservative given the macro uncertainties that we are seeing?
I think the macro uncertainties remain for now. That being said, I think we do expect to have better growth than that, in the near term. Although I think we will have to wait to see, the impact of pricing transmission towards the later half of the year.
All right, if we just focus on the demand, that remains strong across all segments this quarter. But how do you see consumer demand evolving over the next few quarters, particularly after the strong summer season?
I think demand in general has been good, particularly in categories which are driven by summer in South. Although non-South, I think summer categories have underperformed, particularly Northern India has been flat for us. As far as kitchen categories are, we are seeing good traction. We are also seeing good traction in some of the emerging categories like renewables, and all of these factors are helping us. We expect demand in the near term to hold, although I think the commodity increase has been pretty significant and is expected to be high teens as far as the pricing transmission impact is concerned as we what I would say travel through the year. This impact will have to be seen. I think right now demand is holding firm, rather except for categories in certain geographies where season has been a challenge. Particularly the onset of summer has been interrupted with frequent showers, and this has resulted in tepid demand in certain geographies in the country.
Right, so commodity inflation, particularly in copper and polymers, remains elevated. Now, how do you expect your raw material basket to evolve over the next 2 to 3 quarters, and what is your inflation outlook?
I think inflation should ease. I think once the uncertainty moves away, a lot of the current pricing inflation is also connected with the current uncertain environment prevailing on account of the Middle East and the other geopolitical issues. In the near term, the prices remain elevated, although there is some moderation in petroleum derivatives. But overall, prices remain elevated, and even commodities like copper and aluminum are staying significantly higher. I think the resolution of the current conflict in the Middle East will be key and critical to easing of commodity prices.
So talking of commodity prices, now if commodity prices remain elevated over or increase further, what would you prioritize protecting margins through pricing, or would you absorb part of the inflation to safeguard demand?
No, I think it's critical to protect our gross margins as it's an implicit and critical element in our overall operating model, and so protecting gross margin is going to be essential to funding our growth. And is also going to be essential to making investments for the future. So I think, as far as we are concerned, we will, try to protect our gross margins. And as you have seen, we have done so in Q1, and to some degree, we have been impacted in some geographies, because of faster pricing transmission compared to competition. But I think it's critical because I think in the midterm things all settle down. But in the short term, if we don't protect our gross margin, it's going to be difficult to protect our operating model.
Right. So, Mr. Venkatraman, last quarter you indicated that 70 to 75% of the required price hikes had been implemented. So tell us, what is the current status of pricing actions, and do you expect further price hikes if commodity costs do remain elevated?
I think we have been, progressively taking price increases. I think a significant chunk of the increase was taken in the month of March. We had subsequent increases in May and June, which are also keeping in mind competitive actions. Even in the current quarter, we do expect to transmit pricing in some of the categories where pricing transmission has been delayed. The pricing transmission will continue till this commodity impact is fully transmitted to the market. As we speak, 90-95% of the pricing transmission has already been undertaken, and there is about 5 to 10% of pricing impact, which we expect to transmit in the current quarter.
Let's talk about consumer durables. Consumer durables returned to profitability this quarter. But what operational or strategic changes drove this turnaround? And what is the medium-term margin aspiration for this segment?
I think in the midterm, consumer durables as a category, will recover profitability, on the back of, product refresh. The product refresh actions, have been rolled out over the last 10 to 12 months, and which has also enabled the improvement in profitability in this category. That being said, even as we speak, the transmission has been a bit slower in these categories compared to other categories. So we do hope to further recover margins in this category as we go forward.
Right, so let's turn our focus now to working capital efficiency. Now, it's improved significantly this quarter. What operational measures do you think have actually led to this improvement? And how much further optimization will be possible?
I think, on the back of, good demand starting last quarter, which is, the quarter four of last financial year, we have been, witnessing better traction compared to our forecast. And this has resulted in our overall inventory coming down. Also, as, in large parts of the country, particularly south, which is where we get, 50% of our business, the weather has been positive. So collections have also been good. And the combined action of better collections and the faster velocity of movement of finished goods off the shelves has resulted in a more efficient working capital. So I think this will be sustained through remaining part of the year, is what we expect, as we expect the demand to hold up through the remaining part of the year.
All right, Mr. Venkatraman, that's all the time we have. But thank you so much for participating and answering all the questions today for us. Thanks. But let's take a tech check on V-Guard, and Kunal, I'll come to you. So far, 8% move we can see. Technically, should one be booking profit, or is there time to just hold, or if want to initiate a buy, what levels?
I think it's a good time to book profits for V-Guard, because the last 2 days we've seen the price action being quite strong. But the volumes somehow give us a sense that these are intraday trading volumes, or very short-term oriented trading volumes for the stock price. The stock was priced at almost 500, 550 in 2024 and has gone through almost like a 40%, 45% correction the last 2 years. And there have been multiple phases where the stock has seen a counter bounce rally, where the stock has bounced back in a very short span of time. But then the stock has come back into the selling pressure back again in the last 1.5 odd years. So I would expect very similar kind of a price action going forward. It's a good time, I think, for traders to look at booking profits if it's a very short-term kind of a time frame.
Right, so Kunal over there are suggesting that it's time to book profits. Thank you very much for that one, Kunal. We slip into a short break here on Buy Now, Sell Now. But when we come back, we get you more. So do stay with us. All right, thank you very much for staying with us on ET Now. And Juniper Green Energy has quietly built itself into one of the country's top 10 renewable power producers in less than a decade. Now, the company has opened an IPO worth of about 1,800 crore rupees entirely through a fresh issue. And Sajid caught up with the management to understand what their growth roadmap is looking like.
Well, Juniper is an IPP. We're one of the largest IPPs in the country today from the capacity, contracted, under construction, and award point of view. The company has today about 10,000 gigawatts of peak capacity, which is out of which 2,400 is operational, 6,000 will be up and running in the near future, and then which will take our total capacity by 2030, 2032, probably to about 10,000. The portfolio of the company consists of about 83% of wind, solar, hybrid, and FDRE. We have only 17% of vanilla solar, which makes us differentiating from the point of view that probably one of the highest in the industry to have that composition of the portfolio.
Give us a sense of the kind of usage of the funds that you're going to do. You are raising 1,800 crores in fresh equity. How are you going to use this amount?
All for expansion of the capacity. There's no FS, as you know, so all the capital that will be raised is going to use for the capacity expansion.
Okay. If I look at your revenue profile there, It's gone up from 508 odd crores in FY25 to 719 crores. What is the kind of timeline that you have for completion of these projects, and when are they going to get commercialized?
So different projects will come at different stage. As I said, we are today 2,400 megawatts of peak up and running capacity and 500 megawatts of battery. We have all the land and all the connectivity de-risked, and under construction projects will take us to the capacity of about 6,000. So the timelines will be roughly FY 2028.
At the end of FY27, what would be the expected commercial capacity which would be installed?
As projects are under execution, I can't give you an exact amount of capacity that can be there. The target is to get to 6,000 megawatts of capacity by FY28.
Give us a sense of the off-takers that you have. Currently, you have Gujarat Urja Vikas Nigam as one of them, and the other one being Maharashtra State Electricity Distribution Company. For the 6,000 megawatts which you're trying to bring in the next 2 years, do you already have firm commitments of PPAs signed with all those off-takers, or and is the existing ones taking up all those power, or you have new off-takers coming in?
So the rest of the capacity primarily goes to new off-takers. We have SJUVN, we have NHPC, we have NTPC, we have Tata Power. So the skew will change by the time we reach to the capacity of about 6,000. We'll have about 75+% capacity to the central government off-takers. And Gujarat and Maharashtra, while they'll stay, they'll be about 25 to, roughly 25 to 27% of the offtake going forward. So right now, the capacity installation which we're doing is under the FDRE and the wind solar hybrid projects that we have won.
And what would be the pricing that comes into play here once these goes commercial?
So we'll have an average price of about 3.64 rupees. We are, which we believe should be one of the highest pricing in the industry. Again, this primarily goes because of the mix of the portfolio. And although we had earlier vanilla solar, which was about anything between 3 to 3.1, going forward, the tariffs will be higher because of the mix of tariffs from FDRE and wind solar hybrid are much higher. So which will lead us eventually to an average tariff of about 3.64.
And does it include battery as well, or is it exclusive of battery?
The capacity which I mentioned, 2,400, as of now we have about 500 megawatts of battery, but the battery capacity will be ramping up to about 4.5 gigawatt hour once the portfolio is complete, once the existing contracts are executed and completed.
Understood. Can you also take us through the future projects that you would be looking at? Because you've given us an indication of how you're going to ramp up the entire portfolio by 2028, and which is basically completion of the under construction projects, which is there. But in the future, is it all through bidding through SECI orders, or is it going to be independently you're going to set up more?
We'll be looking at whichever tenders come from. The capacity that I've told you and the expansion is all, subject to, as you can imagine, a lot of other things. But going forward, as the new tenders will come in, the country has to ramp up the capacity from 270 gigawatts of renewable to about 500 gigawatts of renewable. The battery capacities, which right now total 10 gigawatt hour, is going to go to about 300 plus gigawatt hour in the country. So the capacity expansion is going to be huge. So we believe that going forward, there'll be more opportunities for us to bid in the new tenders that will come, to grow the business.
Can you also take us through your debt profile at this point in time, how you're going to bring it down? Because if I'm not wrong, it's somewhere around 12,900 odd crores of the total borrowings that you have. What is the kind of plan that you have to delever yourself?
So if you look at these projects, on the infrastructure projects generally, the funding happens on 80-20 basis. And the minute we install our projects, the whole capacity is sold for 25 years. So the debt profile of these businesses, is different, especially on the infrastructure businesses, because effectively your offtake is signed for 25 years. So infrastructure companies tend to have higher debt because of large capex. And most of our debt sits at the project level. We have only a 1,500 crore debt at the holdco level. Other than that, and we have about 3,300 crore of equity that's already been put into the business. So the debt primarily will stay at the project level and will be paid back, through the sale, which is 25-year PPAs that we have signed with various utilities.
All right, so that was Juniper Energy conversation with the management. But then let's shift focus to Star Health, and they have reported a strong set of June quarter earnings. There's a sharp improvement in underwriting performance that aided profitability in a highly competitive health insurance market. The stock is almost flat right now with 2% up. But then if we look at the underwriting profit of almost 111 crores in Q1 FY27 compared to just 16 crores a year ago, this reflects better pricing, claim management and risk selection, which is being reflected. The underwriting profit is the money earned from insurance operation before investing that income. But we are also looking at improvement, that has helped drive profit, which is PAT of almost 25% year on year to 550 crores from 438 crores in the corresponding quarter last year. The combined insurance service ratio, which is CISR, which is a key measure of underwriting performance, it has improved to 97% from 98.7% a year ago. The ratio below 100% indicates that an insurer is making money from its core insurance business before investing gains. But then let's look at the stock movement also, and let's all talk about the entire sector and Star Health as a player. Kunal, technically, how is the stock impacting or showing the movement as per the results?
Nothing major on Star Health, frankly, because even though the stock has recovered 10-15% in the last 3 months, but then from the 2025 war highs, the stock is still trading to a negative bias. The longer-term trend is still on the negative side for Star Health. It needs to break past above a series of major resistances on the weekly and the monthly charts. Only about that is where I would believe that the trends would start to improve significantly for the stock. Those levels are closer to 640, 645 for Star Health. So till the time the stock is trading below those levels, we may expect that the stock is going through a recovery or a rally, but then those rallies could tend to fizzle out very quickly.
Right. Kunal, thank you for that one. Now, Nilesh Kambli, the CFO of Star Health and Allied Insurance, is with us now. Hi, Mr. Kambli. It's a good set of numbers this quarter. Combined ratio, PAT and ROE have all improved meaningfully year on year, with the loss ratio improving for the fourth consecutive quarter. Now, could you walk us through what has led to this consistent improvement?
We started this journey 18 months back when we said that, we want to grow profitably. For the quarter, our growth is 23% when it comes to retail business. As you correctly said, it's a fourth consecutive quarter of improvement in the loss ratio. All this started with our prudent underwriting guidelines, risk-based pricing. We have been taking pricing increase consistently over the period. Our focus on profitable business, avoiding certain portability markets, certain geographies which are not profit-making, loss-making, or rather they are loss-making. Our focus on fraud, waste and abuse to control the losses. All this has led to a consistent improvement. One more factor which has also helped is the home healthcare and telemedicine implementation that we have done. We provide medical services to the customers at the care of their home or provide a second opinion, which has also helped us in controlling on our loss ratio. So we believe this is more structural in nature. There is no one-off, and we believe the improvement should be consistent over a period of time.
All right. Now, of the 67.5 to 68% retail loss ratio, how much is structural improvement, sourcing, portfolio mix versus one-off or seasonal tailwinds, lower teleconsultation cost or favorable claims timing?
Loss ratios on a quarterly basis are seasonal in nature. Typically Q2 and Q3, the loss ratios are higher because of the impact of fever and infectious diseases during monsoon and post-monsoon. Q1 typically is a quarter where we have a higher impact of surgical claims, and we have seen that playing out during the quarter as well. As I mentioned, the improvement is coming largely because of our pricing actions, our strict underwriting guidelines, because of the focus on fraud, waste, and abuse. And that is more structural in nature. We believe there is no one-off, and the improvement should happen consistently over a period of time as well.
Right. So tell us a bit more about what specifically changed between the high single digit and the mid single digit guidance in the demand side.
No, I think there is some mistake. We have not spoken about single-digit growth guidance. We have been growing at 19% on an overall basis. We have maintained that we should continue to grow around, anywhere between 16 to 18% in line with the growth in market. And on a long-term basis, we should be able to maintain our market share as well. But we believe our growth should come with profits, and we just don't want to grow for the sake of growth. But we believe 16 to 18% growth is something which will be in a position to achieve consistently over a period of time.
How should we think about loss ratio trajectory over FY27 as the long-term policy mix, which is almost 40% of fresh premium, continues to build from here?
So, we have mentioned in the past, we don't want to give any yearly guidance on the loss ratios. We believe combined ratio is the right measure to improve the operating profitability of an insurance company. We believe around 97 to 97.5% on an annual basis is the combined ratio zone which we want to operate in, which will result into a mid-teens to high teens ROE, and that's what we're working at. In FY24, we had given a guidance that we'll achieve that by FY28, and we are well on course to achieve that number with the actions that we're taking.
And Nilesh, the combined ratio has improved to 97% from 98.7%. Now, what combined ratio level do you consider steady over the next 2 to 3 years? And how does further improvement split between loss ratio and expense ratio?
As I said again, we don't predict any quarterly combined ratios. On an annual basis, as I said earlier, we should continue to improve. Last year, we were sub 100 on an annual basis. We should continue to improve for the year as well and going forward. The objective is to maintain consistency when it comes to the operating results, and that is something which we'll strive for. The quarterly loss ratios is a function of various other things. The macro factors, the rainfall, and all that things. Very difficult to predict quarterly loss ratios.
How are you balancing price hikes against the risk of adverse selection, healthier customer churning out? Do you have visibility into persistency by cohort post price hike?
Yeah, absolutely. I think persistency is one important factor for the entire business, which also shows the customer satisfaction, which shows our strength of the agency business. In terms of premium, our persistency is 103%. In terms of volume also, it is high 80s, in terms of volume, which is around 87, 88%. So we believe we are one of the best when it comes to persistency of the renewal portfolio. So in spite of taking price increases, we are able to communicate it well with our customers, make them understand that this is required for the long-term sustainability of this health insurance business. And we are getting good responses, and we don't see any reduction in the persistency of the portfolio. For the new customers, we are able to go about giving them some discounts, making it attractive for the agents as well. And that is how we are building the new portfolio as well as maintaining our persistency or renewal portfolio.
Right. And finally, of course, investment income has risen, but annualized yield has fallen sharply. Is this a duration or asset mix shift, or is this simply a denominator effect that you're seeing from a larger book?
So for the quarter, if we see along with the mark-to-market gains, in fact, the investment yield is very, very good. It upwards of 10%. But what we see is, the portfolio construct that we have a certain 80% of our portfolio is fixed portfolio where we see yields around 7.4, 7.5%. On the equity portfolio, we assume that this will at least give us 10 to 11% return on a long-term basis. And that is where we talk about normalized profit with the investment yield of 8% on a blended basis. And that is how we want to project our financials as well. There can be some short-term volatility, but we believe that's part of the game once we have implemented Ind AS. But over a 3 to 5 year horizon, we should consistently hit a 8% investment yield with the portfolio construct that we have.
Right.
right. Thank you so much for joining in and answering all the questions for us today. Thanks.
Well, thank you very much for staying with us on ET Now. You're watching Buy Now, Sell Now, and we're now taking your WhatsApp queries. The next question that we will be taking is from Nabarun Hazra, and he is asking us about Apple. He holds a quantity of 154. He entered the stock at 1,702 rupees. Now he's wanting Kunal to suggest a future course of action. So, Kunal, what's your view on Apple? Right now, holding about 1% down, trading at 1,636, I think.
Well, it still looks quite okay. I think the worst seems to be behind for the stock price. It's fallen from 2,000 levels to almost 1,200, 1,250 in the last 18 months. And now it's on the path of recovery. This week rather, has been quite positive for Apple. The stock has recovered almost 13.5%. My assumption is that if you're looking at this as, say, another couple of months perspective, then you could probably eye a target of at least 1,750 to 1,800 for the stock price. But I would sense that it's a good stock. Has a good history over the last 4 or 5 years, and my sense is that on the path of recovery, you could probably expect 1750 to 1800 as a target over the short term.
All right. Any specific stop loss that you might recommend?
So I think closer to 1580 could be a decent stop loss, assuming if it's a short term play.
All right, short-term play, 1580 is the stop loss, 1750 or 1800 are the levels that the stock can go in the short term. But let's move on. Let's take Mohit's question. He's from Ludhiana. Concor, Kunal, the buy price is 512 and time horizon is almost 1 year. Okay, so 525 is the level at which it's trading right now, but he's in profits.
I would suggest to hold on. See, I think my sense is that the major part of the correction for Concor started off from 2024. And the stock had corrected more than 50%. Now, what's happened on the daily and the weekly charts is that Concor is now forming a double bottom pattern. There are some signs where volumes have made a comeback for the stock price. And the last 3 or 4 days, for example, the stock has seen a good recovery. So short term, medium term price action, volume action, extremely positive for Concor. If this pattern of double bottom gets completed, we may expect the stock to head towards at least 600, 625 over the next, say, 1 to 3 months. So if your time frame is slightly short to medium term, then I would suggest to hold on to the stock with a potential target in the range of 600 plus.
All right. Right. So the next question is coming in from G. Bikashamia. He's holding GAIL stocks. Now, that's, of course, a major player in the gas utilities industry. He's holding about 250 stocks of it. Entry price was 130, and he wants to know if this is a good hold in the long term. So, Kunal, right now the stock trading at 175. So, what's your sense on this one?
See, I'll suggest to hold on to GAIL as of now. The only reason for that is because the stock is low beta. It's going towards a very steady and a gradual uptrend. But then more importantly, the stock is nearing a breakout. On the short-term swing charts, we are looking at 175, 180 as a potential band of a breakout for GAIL. You've purchased at a lower price, so that's also a buffer for you in terms of holding on. I'll suggest to hold on and look out for this breakout of 175, 180 barrier. If that happens, you might probably get another 20, 25 points on the upside pretty quickly. Closer to 200 is where you can take a call whether you want to book out your profits or not.
He is also looking at buying L&T at the current level. So since you've recommended a hold in GAIL, should he just completely quit the idea of buying L&T and just stay with GAIL?
So I think, of course, L&T is also a good bet. And the fact is that the stock is available at a good discount in the last 1.5 odd month. It's fallen by 400 points from 4,400 levels thereabouts towards 3,900 where the stock is trading right now. So the price is attractive. But then if that's the query that you want to switch from GAIL to L&T, then in that case, I would suggest maybe a partial booking profits for GAIL and take that money out and invest or park into L&T at the current price juncture.
All right. Thumbs up for L&T. You can book partial profits in GAIL. Next question is coming in from Rohit Srivastav, and he's bought Netweb Technologies 500 shares at 51.15, and he can hold for 1 year. He wants to know further upside. Is it possible or not? And if not, then what should be the strategy for short term?
See, it's a bit of a tricky stock, frankly, because the recent price correction indicates that the stock is not yet ready for any kind of a major breakout. We've seen the stock recovering from 3,300, 400 levels towards 5,000 plus mark. But then the manner in which the stock has slipped from those 5,000 plus levels towards 4,200 mark indicates that I would sense that the stock has not yet completed a corrective wave. So you may want to hold on to the stock price, but I would probably be of the view that short-term wise, you might see the stock correcting further. There is a strong possibility that the stock may correct towards at least 3,800, 3,650 kind of a mark. That's where, if you are looking to average, could be a better price points to average, but not at the current levels.
All right, so you need to hold on for the current levels. And in fact, that's all the time we have right now on Buy Now, Sell Now. Thank you very much, Kunal, for joining us. And that's it from Kavita and me.